Aloha, this is Paul Brewbaker, Principal of TZ Economics in Kailua, Hawaii, continuing with a group of four presentations about the state of Hawaii's economy entering 2026. I'll start right up here with the next set of slides that has to do with housing market dynamics as we ended the year in 2025 and moved into 2026. A series of slides originating in the fall 2025 Hawaii Economic Association annual conference, and then adapted at the invitation of the Native Hawaiian Chamber of Commerce and the Kailua Chamber of Commerce for shorter and more varied discussions with those groups. So these slides serve as a bit of a reference backdrop for those meetings. Housing, we'll look mostly at Oahu, but housing in Hawaii has exhibited post-pandemic and moving into a normalization phase now in the mid-2020s, a mix of structural shifts that affected housing preferences and therefore home price dynamics, and also a number of regulatory and other influences that, like interest rates, that caused a lot of movement in sales volumes, as well as in inventories as they built up and were drawn down in the first 5 years of the 2020s. We'll focus mostly on Oahu. So here are Oahu home sales on the left scale, the heavy blue line, as a function of the 30-year mortgage rate. I've inverted. Okay, so the 30-year mortgage rate's on the right side of the screen, and the right side of the screen, and so a rising mortgage rate is a decrease on this screen. So as mortgage rates were rising, as the Fed normalized interest rates following the post-pandemic supply chain inflation, global supply chain inflation in 2021, but especially 2022, as the Fed began to tighten monetary policy and mortgage rates went up from 3% to 7%, you see that dramatic drop in existing home sales on Oahu. These are single family and condo sales combined. And then more recently, and I've lagged these interest rates 2 months, so they're a bit of a leading indicator in this case. You can see as mortgage rates go down, which is up in this chart, as mortgage rates go down, more sales volumes respond. As mortgage rates go up, they respond in the opposite direction, right? So higher rates mean lower sales. And since the middle of last year, we've had a rise in Oahu home sales, which is interesting because it partially reflects the decrease in mortgage rates, which are now down from about 7% to around, or maybe even under 6% in some cases. It's responded to those declining mortgage rates, but also appears to have some life of its own if you think about the magnitudes of the movements here in recent months. So that's an optimistic note, maybe for the housing market. Among the anomalies in Oahu's housing market is that inventories, which I've illustrated here in terms of a concept called months of inventory remaining. So a home is listed, and based on how fast sales are absorbing those new listings, you can calculate how long it would take for the new listings or for existing listings to be absorbed by natural velocity. It's basically an inventory sales ratio. So the higher the inventories, the higher the months of inventory. And you can see in the past, condo and single family home inventories, and I have data going back 30 years to show that for 25 of those years, condo and single family home inventories on Oahu tended to move very closely with each other. That is, the same influences on the single family side of the housing market were having the same impacts on the condominium side of the market. So the inventories rose and fall together. And I mean, you go back 30 years to the mid 1990s, there were 2 years of inventory remaining. That's how much sales had dropped in the aftermath of the Japan bubble. Well, here we were looking pre-pandemic at 2 or 3 months of inventory remaining. So a relatively high velocity transactions of volume in the Oahu housing market with a supportive interest rate environment. And basically, shortly after listing a home, you find a buyer. It takes a couple of months to go through escrow, and there you go. You have a home sale. You have inventories churning over every within 2 or 3 months of listing. This broke apart when the city and county of Honolulu began to beat the drum on short-term rental enforcement, and in this case, undocumented short-term rental enforcement, because a ban on short-term rentals had been in place since 1989. It just hadn't been enforced for 30 years. City Council introduced Bill 9, which increased the credibility of the enforcement threat with a number of mechanisms, and you immediately saw a break between the single-family home inventories, which were declining as interest rates went back down, and condo inventories, which did not follow the improved interest rate environment, but instead began to pile up as condo investors began to dump their housing units. This worsened during the immediate aftermath of the pandemic as tourism went to zero, short-term rentals, had no utilization, and many investors just had to bail out and sell their units because the cash flows weren't there to support the investments. But as the low interest rate environment and what we'll see in a second, a more bubblicious housing valuation dynamic began to appear on Oahu, those condo inventories began to be absorbed. And of course, once interest rates went back up with monetary policy tightening in 2022 and 2023, you saw both single family and condo inventories accumulating. Then in 2024, the state legislature jumped in to pass enabling legislation which would allow counties to crack down even further on short-term rentals. So another big negative for short-term rental investors at the same time that meteorological events around the world and wildfires and hurricanes and flooding were raising insurance premiums, particularly in the condo space, in the multifamily space, because of the vintage, because of the old age of many of the condos in Honolulu. 80% of the high rises in Honolulu were built before 1985. So a lot of old buildings in Honolulu, which, had some trouble with rising insurance premiums. And for all those reasons, a pileup in inventories peaked at the end of 2024, with 7 months in the condo market remaining, and only about 3.5, only half as many. Those, of course, have begun to come down now as interest rates have moved back from 7% or higher to 6% or lower. So the absorption pace of sales has quickened. And therefore, if you look at single family appreciation on the left side of the screen, on Oahu, the path of 4% appreciation established in the 20 teens, apart from a little bit of a slowdown after the Fed began to normalize rates in 2018 and then backed away from that. But you see the median home prices in the single family space surge upward after the pandemic event itself. And what we'll talk about in a second, part of the reason is that with 1/4 of Hawaii workers embracing remote work, it meant that single family detached dwellings with suburban and exurban locations were relatively attractive. Suddenly, discreetly, like for the first time ever, because remote work became acceptable universally, single family detached dwellings in these remote settings saw an increase in demand that was not experienced in the urban core high density condominium market segment. If you detrend these median price data, you can see the overshoot. That's, I mentioned a bit of bubblicious price dynamics in 2021, 2022. When you take this trend out of the data, and that's what we're showing on the right-hand side, you can see how that post-pandemic bubble settled in a range where prices remained now for several years running, 2023, 2024, and despite a little bit of a pullback, this is sort of Trump 2.0, you can see single family prices on, got back on track on this parallel trajectory, a 4% appreciation rate with a one-time jump of about one standard error. So a one-time jump in home prices to a new path, a kind of a premium associated with, a price premium associated with the remote work, post-pandemic remote work phenomenon. And in contrast, on the condo side of the market, is the exact opposite. Condos faded with interest rate normalization in 2018, and then the Fed backed off. And of course, condos languished in the immediate post-pandemic environment because of the loss of tourism, and but then got back on a 5% trend from the 20 teens as we went into this, um, post-pandemic recovery subsequent to the second monetary policy tightening, and then continuing and worsening even for the last 3 years. You see condos really falling away from trend. And I think those other structural factors, such as the crackdown on short-term rentals, but also the permanence of remote work and the shift in housing preference away from multifamily dwellings, has weighed heavily on condos to about the same extent that single family homes have benefited from the same factors, about a standard deviation discount from trend, which is looking more and more permanent. We'll have to see where this goes. On Maui, by the way, where a particularly ferocious short-term rental ban uh, uh, was passed last month in December 2025, seeking to remove 1/3 of Maui's lodging units from the market, from the whole Maui market. I mean, 6,000 out of 21,000, so not quite a third, but certainly 25 or 30% of all Maui lodging units were banned by county ordinance. As soon as that bill was introduced, you could see these deviations from trend for Maui condos simply collapsing. So this is a really good reminder that just talking about bad economic policy results in the adverse economic outcomes that you'd expect. Now, the people who, supported this bad policy believe that Maui condominiums have become so much cheaper because of what's called a fire sales externality. I'm not making that up. This is literally called a fire sales externality, right? One guy heads for the exits, everybody heads for the exits. They're gonna awaken it. They're not gonna wait to see if Maui County does this stupid ass thing. And there you go. Now, are Maui County condos more affordable? And here's the thing: you could just build 6,000 housing units. So the point here is the dynamics can be subjected by these exogenous events like bad economic policy, true to tremendous beatdown in valuation dynamics, and that's what's been happening. The Bill 9 was introduced in January 2025, and here we are in November, December 2025. So good luck with that. This point about remote work, I think, is really important to remember because it is a permanent structural shift. People thought it was temporary pre-pandemic. Maybe 5% of the workforce was engaged in remote work full time or hybrid, some days in the office each week, some days at home. With pandemic onset, we all had to learn how to do this initially. But of course, since the return to office, since the economic recovery, remote work has settled at about 25 or 30% of the workforce nationwide, and in Hawaii at 25%, right at 25%. I don't have those data here because the Census Bureau stopped counting in September 2024, unfortunately. But it was very stable in Hawaii and very stable proportions of about 75% of workers returning to workplaces, and then about a half of Hawaii workers out of the 25%, about half full-time and half hybrid. If you look at who these workers are, you see a distinctive pattern in which persons in households where people are working from home tend to be in households with higher educational attainment, and as a consequence, because higher educational attainment allows people to acquire the critical thinking and analytical skills that very often enable them to enjoy occupational activities that don't require them to be at a physical workplace. As a consequence, if you look at working from home for higher income households, the same thing is true. A majority of persons in Hawaii households earning $200,000 or more work from home at least some days a week. So if you think about how that shift in who it is that's able to work at home, no longer needs to commute to work, no longer and needs to live close to work so that those commute times aren't such a heavy uh, external cost of commuting. You can imagine the pattern of housing demand shifting to these, uh, you know, suburban and exurban neighborhoods and Zoom towns like Maui or, northern Idaho, Coeur d'Alene, Idaho, Wailea, Maui, same thing. Overall, uh, the pattern of publiciousness in this post-pandemic remote work valuation cycle was relatively moderated when you look back at the subprime bubble and the Japan bubble. And here I've adjusted for inflation, and these are condo and single family valuation statewide, an index published by the Federal Housing Finance Agency. And we can break out, the deviation around trend as we have with these other evaluation series. So you can see a little bit more clearly how the remote work impulse was relatively modest compared to the subprime and Japan bubbles, and in which you see a convergence back to trend now slowly unfolding. In terms of, to give you some regional flavor, uh, the amplitude of the valuation cycle is greater on Maui, so you have than on Oahu. So you have, in the case of both, definitely in the case of the subprime bubble, both an overshoot to the high side and to the low side after the financial crisis and Great Recession, characteristic of Maui valuations in a way that wasn't as severe on Oahu. Although in the Japan bubble, the overshoot was much more dramatic because the Japanese investors tended to prefer urban housing and commercial real estate environments uh, as targets. The remote work phenomenon uh, seems to have influenced Maui a little bit more. We'll see where this goes now with the collapse in Maui condo prices. But here you would be thinking a little bit more about vagabond workers and right as it's one thing to work remotely and still live on the island in which your place of employment is located. It's a whole nother to have a place of employment in Silicon Valley, California, and to be living on Maui and working in California. So those cycles in valuations are largely responsible for the cycles of inaffordability, although in the post-pandemic environment, a dramatic increase in interest rates. What did we say, from 3% to 7% or more? So a 400 basis point increase in long-term interest rates, really the largest move in the last 40 years because of the largest inflation in the last 40 years in 2022, which the Fed sought stop very quickly, resulted in the most recent wave of recent erosion of affordability when you take mortgage payments and median income and median home prices, put them in a blender, and calculate what's going on. And therefore, the return of Oahu and presumably neighbor island home prices to longer term trends, this thing you see in the long term data, these returns after inflation, these returns to long term trend, should probably improve the affordability picture in the second half of the 2020s. Just one last thing, I'll mention that there are other forces at work here that are outside Hawaii's characteristics, Hawaii's housing market influences per se, and outside the things we can do with housing policy in Hawaii. Because capital is mobile, certainly within the United States, capital is infinitely mobile, and we do know that investors will, abandon their investments in one place, literally, and swarm to another place if things get out of alignment. That's the force of arbitrage. So when the dot-com bubble was at work in California, but the Japan bubble was unwinding in Hawaii and on Oahu, you saw what had been an unusually high premium for Oahu single-family homes. These are single-family home prices relative to the California benchmarks reverse as the dot-com regional economic impacts affected San Francisco, Bay Area, especially, even relative to, say, Southern California, while Hawaii basically missed the dot-com bubble. And then again later, when you see the subprime bubble, remember the overshoot of Maui, both to the high side and the downside. You see a much greater amplitude in those California. Well, Maui is California. And so my point here, the longer term appreciation, but also these longer term cycles, these are not indices, these are actual median home prices, nominal median home pricing, single family home prices. You can see that certainly Oahu we're showing here, very much connected to markets like Orange County, for example, which is worth more than San Diego, not worth as much as San Francisco or one that I've left out of here, which is San Jose. Right. So notwithstanding our geographic isolation and remoteness, capital is mobile within an economic union, and you'd expect that the investors who can move their capital electronically will continue to have an impact on the islands. Just to summarize what I call the donut effect, which is the fact that post-pandemic housing demand shifted away from urban cores, certainly for detached dwellings, towards suburbs and exurbs and zoontowns like Maui across state lines, resulted in a bit of bubbleiciousness that is now dissipated. On Oahu, single-family home prices remain on a parallel track with about a 1 standard deviation based on the 20 teens dynamics, about a 1 standard deviation premium over the long-term trend, while condos have about an equal discount relative to that trend, burdened idiosyncratically by short-term rental prohibition and some other impacts like a pattern of catastrophic risk increase nationwide or worldwide that caused insurance premiums to suddenly jump to the disadvantage, particularly of older structures which dominate the core Honolulu high density urban high rise market. And about half of the annual price appreciation, at least in the early phase of this somewhat bubblicious remote work surge in the early 2020s home prices was identified as attributable to the remote work phenomenon itself. So a reminder that structural changes, we have cycles, you see the cycles in the valuations, we have cycles in home building, we have cycles in home sales, we have interest rate sensitivity, but every once in a while something comes along, and in this case the pandemic came along And who knew that 1 out of 4 workers post-pandemic would not have to go back to the workplace every day. If you work in a hotel or resort, if you're a server, if you're a skilled construction worker, oh yeah, plenty of jobs require that you be on the job site. But what the pandemic was to change uh, workplace norms to enable a persistence of about 1/4 of Hawaii's workforce engaged in work remotely, and therefore to change the spatial pattern of demand for housing. And with that, I'll stop and say aloha and check it out. I've got a couple more of these on the channel. Thanks.